While the average American investor is celebrating a 4 or 5% return on their high-yield savings accounts or treasury bonds, global hedge funds are quietly moving billions of dollars into an alternative sovereign market, a market that offers double-digit returns fully backed by real-world assets and protected by institutional-grade legal frameworks. To most investors in the United States and Europe, the financial landscape seems limited. You either risk your capital in an overvalued stock market or you lock your money away for returns that barely beat inflation. But there is a massive anomaly happening right now in the Southern Hemisphere, a country with a highly sophisticated, fully digitalized banking ecosystem that pays some of the highest real interest rates on the planet. We are talking about fixed income, agricultural bonds, and real estate funds that legally pay monthly dividends directly into your account. In this video, we are pulling back the curtain on the Brazilian capital market. I'm going to show you how institutional investors navigate this territory safely, how the legal protections mirror and sometimes exceed the US system, and exactly how you can position your capital to harvest these returns. Let's address the elephant in the room. When most Western investors think of South America, they think of volatility, political noise, and currency risk. And for decades, that skepticism was justified. But Wall Street thrives on keeping retail investors afraid of the markets where institutional money makes its biggest gains. While the media focuses on political headlines, companies like BlackRock, Vanguard, and international sovereign wealth funds have been quietly scaling their operations in Brazil. Why? Because the underlying macroeconomic reality has shifted. Brazil is no longer just a developing nation. It is the undisputed agricultural superpower of the globe. It feeds over 1 billion people daily. And to finance this titanic industry, the Brazilian financial system developed specific, highly regulated investment instruments that simply do not exist in the American market. Instruments like Fiagros, agribusiness investment funds, and CRI's real estate credit certificates. These are not speculative tech startups. These are legal contracts tied to the very land, infrastructure, and commodities that the global economy depends on to survive. And if you think your principal isn't safe, consider this. The Brazilian equivalent of the FDIC, known as the FGC, legally guarantees bank deposits and fixed income applications up to 250,000 reais per institution. The architecture is built for stability. The only question is, why aren't you utilizing it? To understand the true power of this market, we need to look at how wealth is distributed to investors. In the United States, equity investors and REIT holders are accustomed to quarterly payouts. You wait 3 months to see the cash flow from your real estate investments. In Brazil, the law rewards cash flow investors differently. The country's real estate investment funds, known as FIIs, and agribusiness funds, known as Fiagros, are legally mandated to distribute 95% of their net profits. And here is the game changer. These distributions happen monthly, and they are completely tax-free for individuals at the local source. Imagine investing in a portfolio of AAA corporate skyscrapers in the financial heart of South America, or backing the top tier of global agricultural producers and receiving a predictable cash deposit every 30 days. Because these funds trade publicly on the B3 exchange, you have the liquidity to enter and exit positions with ease, combined with a dividend yield that routinely doubles or triples what American REITs offer. It is the ultimate vehicle for monthly passive income hidden in plain sight. Now, an intelligent investor does not just chase high yields. An intelligent investor manages risk. The primary concern for any foreigner investing in a foreign market is currency fluctuation. If the local currency devalues against the US dollar, it can erode your gains. This is exactly where strategic asset allocation and corporate law come into play. Sophisticated investors do not simply buy local currency blindly. They utilize hedging strategies or they specifically target inflation-protected corporate bonds, known as debentures, which pay a fixed interest rate plus the official inflation index. This creates a psychological and financial floor that protects your purchasing power. Furthermore, entering this market is no longer the bureaucratic nightmare it used to be. The Brazilian Securities and Exchange Commission, the CVM, has established clear legal pathways, such as the Anexo 4 framework, designed specifically to welcome and protect foreign capital. However, doing this successfully requires the right architecture. It requires understanding international tax treaties, setting up the CORIC. The global financial paradigm has shifted. Relying solely on Wall Street's traditional playbook means leaving massive, legally backed yields on the table. The institutional money has already crossed the border. The infrastructure is ready. The returns are proven, but navigating international capital markets safely requires precision, compliance, and local legal expertise. You need to know which funds are resilient, how to handle foreign exchange correctly, and how to structure your investments to minimize global tax exposure. If you are a high net worth investor, a business owner, or an asset manager looking to diversify your portfolio with double-digit asset-backed returns, you don't have to guess the way. Click the link in the description below to schedule a private strategic consultation with our international legal and financial advisory team. We will help you build a secure, compliant gateway to the highest yields the world has to offer. Don't just watch the global wealth shift, participate in it. Subscribe to Global Yield Intelligence for more institutional market breakdowns. See you in the next report.